James Carville, a former campaign manager for Bill Clinton, said, "I used to think if there was reincarnation, I would come back as a president or the Pope. But now I want to come back as the bond market. You can intimidate everybody." Why is the bond market so important? How can it influence government policy? Well, first of all, let's start with the basics. When the government wants to borrow money, it wants to spend more than it receives in tax. To get that extra money, it sells bonds, or in the UK, sell gilts. It's the same thing, just different term. And basically, the government promised to pay the buyer of a bond a fixed interest payment for the term of a bond. So, for example, you may buy a £1,000 bond at 5% interest, which means for the next 10 or 30 years, the government will pay you £50 every year, 5% of the value of the bond. Now, you can keep that bond until it matures in 20 years or 30 years' time, but also you can buy and sell it on the bond market. And the bond market is worth trillions of dollars around the world because people are often buying and selling bonds. It's a good form of investment, it gives an interest, and it's seen as a safe, secure investment, usually. Now, supposing that there was increasing demand for government bonds, this would cause the price of bonds sold on the open market to increase. So suppose that this 1,000 bond rose in price to £1,200. In that case, you would still get £50 a year. So the effective yield from that bond has now fallen to 4.1%. Then if people sell bonds and the price falls, then the opposite will happen. Suppose the price of a bond falls to £800, then you're still getting £50 a year, so the effective yield has increased to 6.2%. And this is the law of the bond market. As the price of bonds rise, the effective yield declines, and vice versa. Now, what is the importance of a bond market? Well, first of all, it affects the cost of servicing UK and government debt. So if bond yields rise, then it's more expensive for the government to borrow. To give you an example, in 2022, the UK had debt of 2.4 trillion, with an average bond yield of 3.75%. That's an annual debt interest payment of around £88 billion. But supposing that bond yields rose and the average bond yield was now 5.5%, in that case, the annual debt interest payment has now increased to £129 billion. That's a 41 billion increase in government spending just because of a marginal increase in the average bond yield. And this is an opportunity cost, because if the government is spending an extra £41 billion on debt interest payments, then that's £41 billion they cannot spend on healthcare or education. Bond yields can also have an influence on how much the government can borrow, because if the bond market is suspicious about a government's capacity to repay debt, then bond yields will rise. It's called a risk premium. So, for example, developing countries like Argentina, who have defaulted on their debt in the past, they have to pay a risk premium. And so for the Argentinian government to borrow on international markets, they will have to pay higher interest payments than other countries with low risk. But if a country sees a deterioration in its situation, if markets are concerned that the government's finances are not secure, then bond yields may rise. Also, the bond market can have an influence on the stock market. If bond yields increase, it's more attractive to buy bonds, and so people may sell shares to buy bonds, and then the stock market falls. And there's concerns at the moment that the rising yields on bonds could cause a serious fall in the share prices. Also, higher bond yields have an impact for investment, because if the government bond yields are very high, then investors will be happy to buy bonds from the government, and therefore they won't be lending firms money to invest. So high government bonds make it difficult for firms to raise finance themselves because interest rates are high, and this is something known as financial crowding out, when high government bond yields reduce investment in the private sector. Now, can the bond market influence government policy? Well, yes, it definitely can. First of all, let's have a look at the period 2010 to 2012. This was after the great financial crisis. Most European countries went into recession and government borrowing rose, debt increased. And those in the Eurozone, countries like Spain, Portugal, Italy and Greece, they saw a rapid rise in bond yields because markets were concerned about their debt. And also, very importantly, at that time, there was no lender of last resort in the Eurozone. The ECB was unwilling to buy bonds. And so markets were worried about liquidity and they sold the bonds and the yields rose. Now we can contrast that with the UK. The UK had its own central bank, its own currency, and so markets didn't fear a liquidity shortage in the UK. And the UK actually borrowed more than many other countries. Annual borrowing was around 10% of GDP in 2010, but bond yields fell. And they fell for the next few years, even as government borrowing rose. And that shows that the bond market in the UK was quite relaxed about government finances. But in the Eurozone, they didn't have this lender of last resort until 2012, when Mario Draghi said he would do whatever it takes. And he bought bonds to reassure markets and yields fell. Now it's argued that the fear of a bond market can be enough to change government policy. So when the UK pursued austerity under Cameron and Osborne, one of the arguments they made was that we should be careful about the bond market. If we borrow too much, yields will rise and they won't lend us money. And this was one reason behind austerity. However, some economists argue that this fear of the bond market can be misplaced. In an era of low inflation, low interest rates, the government shouldn't have worried about borrowing, and the fear of a bond market was unjustified. However, when we come to 2022, the bond market kind of gets its revenge because their circumstances are different. Inflation is now over 10%, and sterling has been weak. The UK's economy has been underperforming. And then out of the blue, well, not completely out of the blue, but the government introduced unfinanced tax cuts worth £45 billion plus the energy price guarantee. And they didn't want to let the OBR do any forecasts. And the markets were quite concerned about this budget because they felt that debt was on an unsustainable path. The government weren't being serious. Now, I've covered this issue in more detail in a different video on the UK Crisis Explained. But basically, the bond market reacted very badly to all these unplanned tax cuts. And so there's a big sell-off of government bonds, which hadn't happened for many years. And as they sold bonds, interest rates rose. And this creates a real headache for the government because higher interest rates will increase costs for business, mortgage owners, and it could lead to lower growth quite soon when interest rates bite. And because of the adverse reaction of the bond market, the government had been forced into a U-turn. Now, admittedly, there are political reasons as well, but definitely the bond market didn't help, and they reversed a planned cut in the 45p tax rate. And also, perhaps even more importantly, the government has said they're going to be very strict on government spending, and it's likely that they will try to cut benefits in real terms and not increase them in line with inflation like they are doing with pensions. But the bond market here is playing a role because its adverse reaction to big increase in deficit, putting pressure on the government to balance its books. Another example of the bond market having a big influence on politics and the economy in the late 70s. When Jimmy Carter took office in 1976, government bond yields were around 8%. By the time he left 4 years later, they'd increased 33% to 12%. So the value of bonds had fallen 33%. And this adverse reaction was quite important politically because he was associated with high inflation, high interest rates, and he was criticised for allowing government spending to increase too much, contributing to inflation and the high interest rates. This was a big factor in Carter losing the 1980 election and Ronald Reagan coming with a very new economic policy which involved cutting spending on benefits. Although ironically Reagan did increase the deficit because of the big tax cuts he introduced. But anyway, the important thing is that the bond market can definitely have an important influence. And for many years, it may be very quiet. Not much happens. And we've had quite a quiet bond market ever since 2010, 2012 in the UK. But the recent experience shows that the bond market can always get its revenge, and it can bite governments just when they least want it. And it was interesting that I read an article by the former left-wing Labour Chancellor, what's his name? McDonnell, where he says that he was very concerned about the bond market because they had quite a radical left-wing agenda. So he made it a point to speak to city financiers. They didn't particularly like his policies, but he wanted to reassure them that they would not do anything unexpected. And so one lesson for any government to learn from the recent crisis in the UK is be very careful about political gimmicks that spook the bond market. Because if they had pre-announced a cut in 45p tax rate, the reaction may not have been so negative so quickly.